$65 billion. That was the number on the statements. The only problem was none of it existed. Not a single dollar of it had ever been invested. For decades, one man convinced the wealthiest people in the world that he was quietly making them rich. He was not. He was reading their mail, typing new numbers, and cashing their trust like a check. This is the autopsy of the largest Ponzi scheme in recorded history. The patient is $65 billion. The cause of death is a lie, so simple it should have been caught on day one. Bernard Lawrence Madoff was born in Queens, New York in 1938. He was not born into wealth. He was born into ambition. He started Bernard L. Madoff Investment Securities in 1960 with $5,000. He earned lifeguarding and installing sprinkler systems. $5,000. He built it into one of the most respected trading firms on Wall Street. At his peak, he was chairman of NASDAQ. People trusted him not because he was flashy. They trusted him because he was quiet. He was the serious one. The one who did not brag. The one who turned you away if you were not the right kind of client. Exclusivity was the product. The scheme was the factory. Here is how it worked, and once you understand it, you will never look at a brokerage statement the same way again. A Ponzi scheme has one engine. New money pays old investors. That is the whole machine. You bring in $100 new. You pay the people who gave you money last year with those dollars. You tell everyone their account is growing. Nobody asks to see the actual trades because the statements look real. The numbers look real. The returns look real. Madoff was generating steady, almost suspiciously consistent returns. Around 10 to 12% per year, year after year, regardless of whether the market was up or down. That consistency was not a sign of genius. It was a sign of fraud. Real markets swing. Real portfolios lose money sometimes. Madoff's never did. He called his strategy split-strike conversion. It involved buying stocks and using options to protect against losses. It sounded credible. It was fiction. The options trades he described were never executed. The stocks were never purchased. The money went into a single J.P. Morgan Chase checking account, and from that account, he paid whoever asked for their money back. The investors were not naive people. They were banks, hedge funds, charities, universities, celebrities, and some of the sharpest financial minds alive. Fairfield Greenwich Group put in over $7 billion. Banco Santander had exposure of nearly $3 billion. Elie Wiesel's foundation lost $15.2 million. Steven Spielberg's charitable foundation was hit. The Wilpon family, owners of the New York Mets, lost hundreds of millions. These were people with advisors, lawyers, and accountants. They were fooled not because they were careless, but because the system around Madoff gave them no reason to look harder. His auditor was a three-person accounting firm operating out of a strip mall in Rockland County, New York. 3 people auditing a multi-billion-dollar operation. The SEC investigated him multiple times and found nothing. Harry Markopolos, a financial analyst who had figured out the fraud as early as 1999, submitted detailed warnings to the SEC in 2000, 2001, 2005, 2007, and 2008. He calculated that Madoff's stated strategy was mathematically impossible. The SEC did not act. For 17 years, the 17th floor of the Lipstick Building in Midtown, Manhattan, housed the fraud operation. The actual investment advisory business ran separately from the legitimate trading firm one floor below. The employees on 17 handled the fake account statements. They used an IBM S-400 computer system to generate fabricated trade records. They backdated transactions. They picked investments that had already gone up so the paperwork would show profitable trades. The operation was meticulous. It was also completely detached from any real market activity. Thousands of accounts, millions of pages of statements, zero actual trades. The unraveling came fast. In late 2008, the financial crisis hit the global economy like a freight train. Markets crashed. Investors who needed cash started requesting redemptions. In November of 2008, alone Madoff faced withdrawal requests totaling $7 billion. The checking account could not cover it. He had been robbing Peter to pay Paul for so long that there was no Peter left. On December 9, 2008, Madoff told his sons Mark and Andrew, who both worked at the firm in the legitimate trading division, that he was finished. He told them the investment advisory business was a fraud. He said it was all one big lie. His sons did not go to him the next morning. They went to a lawyer that night. The lawyer contacted federal authorities. On the morning of December 11, 2008, FBI agents knocked on the door of Madoff's Manhattan penthouse on East 64th Street. He told them he knew why they were there. He said he had no good explanation and that he was sorry. He was arrested and charged with securities fraud. He pled guilty on March 12, 2009, to 11 federal felonies. In the courtroom he said, quote, "I knew what I was doing was wrong, indeed criminal." He did not offer an explanation for why he started. Prosecutor sought a sentence of 150 years. Judge Denny Chin agreed. 150 years. He was 68 years old at sentencing. His wife Ruth was stripped of most assets, but allowed to keep $2.5 million. His son Mark Madoff died by suicide on December 11, 2010, exactly 2 years after his father's arrest. Andrew Madoff died of cancer in 2014. Bernie Madoff died in federal prison in Butner, North Carolina on April 14, 2021, at the age of 82, having served just over 12 years of his sentence. The trustee appointed to recover assets for victims, Irving Pickard, has spent years hunting down every dollar that left the scheme. Over $13 billion has been recovered and distributed to victims, out of an allowable claim pool of roughly $19 billion in actual cash losses. The $65 billion figure on the statements was phantom profit that was never real, but $19 billion in real money walked in and never came back out. Pickard pursued banks, feeder funds, and even investors who withdrew more than they put in, on the theory that those profits were other victims' principal. So what is the lesson the autopsy leaves behind? The lesson is not that rich people are gullible. The lesson is that consistency is not safety. A return that never fluctuates, a manager who never has a bad quarter, a strategy too complex to explain clearly but too profitable to question. These are not green flags. They are the autopsy waiting to happen. Every real market breathes. It goes up and it goes down. When something only goes up, when the statements only show gains, when the auditor works out of a strip mall and nobody asks why, that is when you should be most afraid. Madoff did not invent the Ponzi scheme. Charles Ponzi did that in 1920. But Madoff perfected the camouflage. He hid the oldest fraud in finance behind a reputation so pristine that asking questions felt like an insult. The $65 billion never existed, but the silence that protected it for 40 years, that was very, very real.